all you need to know about asset class. Let's break down this table together. Start with the first row, cash and cash equivalents. As you can see in the table, cash makes up roughly 15% of total US financial assets and about 10% globally. This includes savings accounts, money market funds, and treasury bills. The nature of cash is simple. It's liquid and safe. The return comes only from interest, which is why the table clearly shows very low returns and poor inflation protection. Cash is best used for emergencies and short-term needs, not for building wealth. Now move to the second row, bonds. Notice how large this category is. Bonds represent around 35% of both US and global financial assets, with a global market size of over $130 trillion. Bonds are debt instruments, meaning you are lending money. Their return comes from fixed interest payments, which is why the risk is lower than stocks. In the table, you'll see bonds are marked as having low to medium risk, moderate economic sensitivity, and limited inflation protection. This is why bonds are mainly used for stability and income, especially during stock market volatility. Next, focus on equities or stocks. According to the table, equities make up roughly 30% of global financial assets. With a market value of over $100 trillion, stocks represent ownership in companies, and their returns come from capital gains and dividends. You'll notice stocks have higher risk and higher economic sensitivity because they rise and fall with business cycles. However, they remain the primary driver of long-term wealth growth, which is why almost every long-term portfolio relies heavily on equities. Now look at the largest asset class on the table, real estate. Globally, real estate is worth over $300 trillion, making it the biggest asset class in the world. Its nature is tangible and returns come from rental income and property appreciation. As shown in the table, real estate has strong inflation protection and moderate to high economic sensitivity. This is why investors use real estate to generate income and protect purchasing power over time. Next, move down to commodities. Commodities like gold, oil, and agricultural products make up a smaller share, about 5% of global assets, but don't underestimate them. The table highlights commodities as having strong inflation protection and high sensitivity to economic and geopolitical events. Their return comes purely from price movement, not income. This makes them ideal as hedges during inflation and crises, rather than long-term growth engines. Now let's talk about alternative assets. This category includes private equity, hedge funds, collectibles, and crypto. As you can see, alternatives account for roughly 7% of global assets. Their nature is non-traditional and often illiquid. The table clearly marks them as high to very high risk with very high economic sensitivity. Investors use alternatives to boost returns and diversify, but usually in small outlets. Finally, look at cryptocurrencies listed as a subset of alternatives. Despite all the attention they receive, crypto makes up less than 1% of global financial assets. The table highlights extremely high risk, extreme volatility, and unproven inflation protection. Returns come entirely from price appreciation. This is why crypto is best used for speculation and asymmetric upside, not as a core portfolio foundation. Now, step back and look at the table as a whole. What does it tell us? It tells us that no single asset class does everything. Cash gives safety, but new growth. Bonds give stability, but limited upside. Stocks create wealth, but with volatility. Real estate produces income and fights inflation. Commodities protect during crises. Alternatives add return potential and risk. This is why diversification works. The table isn't just data. It is a map of how money moves globally and how smart investors allocate capital across different economic conditions. The goal is not to pick the best asset class. The goal is to combine them intelligently, because successful investing is not about prediction. It's about allocation, balance, and time.